Mēģināšu pievērst jūsu uzmanību trešajai sesijai, un tagad mēs pārcelsimies no Baltijas valstīm nedaudz tālāk. Un šim mērķim pie mums ir atbrauks uz Rīgu ciemos man kolēģi Klaudija Kreps no Vācijas, Nīderlandes, mūsu galvenā biroja, un viņams mazliet pastāstīs, kas ir tās lietas, kas ir jāņem vērā, ja jūs plānojat doties ar savu biznesu uz Vācijas pusi.
Yeah, thank you, Elena. So welcome, everyone. I'm very pleased to be here with you today and to give you a... Okay. So, yeah, okay, no, okay. And to give you an introduction of our tax system in Germany. As you might already know, Germany has a very, let's call it, classical tax system. We have actually all types of taxes you can think about. The aim of this presentation is to give you an idea of different taxes we have, and also to give you some indications of different possibilities to invest in Germany, with a focus on, of course, business purposes, and also with regard to investments in real estate. So if you have any questions during my presentation, just please raise your hand and ask, and then I will try to answer your questions and to give you some advice. So I would like to start by giving you an idea of our different types of taxes. Then I will go on with business investments in Germany, how you can do it, which legal forms do we have, how are they taxed, which limitations or restrictions, for example, for the tax deductibility of expenses do we have, how do we handle tax losses in Germany, and also international aspects, especially now with regard to this audience focused on Latvian-German relationship. Then I will continue with investment in German real estates, because in our practical life we see it quite often that at least, or many foreign, for example, businessman or someone is investing in German real estate at the moment, and I will finalize my presentation with a short summary of our inheritance and gift tax system, because this can also be relevant even if you are not living in Germany. In general, as in many other countries, we distinguish between unlimited and limited tax liability. This means if an individual has a flat or an apartment, or we call it place of residence in Germany, then he or she is subject to unlimited tax liability, which means that she is taxed on the worldwide income. The same applies for companies with its seat or its place of management in Germany. So this is very important to note, that even, for example, if you have a Latvian company, but it is managed by a German manager, then the Latvian company will very likely be subject to unlimited corporate tax liabilities in Germany. So quite often we have situations where we need to analyze, okay, where is the place of management of a company? And quite often we have the situation that when the company was established, it was not recognized that there could be an issue, that there are also tax obligations exist in other countries due to the place of management. On the other hand, if the criteria mentioned for unlimited tax liabilities are not fulfilled, then the German tax system only taxes German-sourced income. For example, of course, business income, capital income or investment income, rental income, as long as it is related to German-sourced assets. In general, we have two types of income tax, one for individual and one for corporation. The individual income tax is based on the annual net profit or on any other income you might have. And it's, we call it progressive tax rate, which means that it, depending on the amount of income you achieved during the year, it goes up to 45%. So you be taxed with a rate of 45% if your annual income exceeds 250,000 euros. And below that, it is difficult to say because, as I already explained, we do not have certain steps. It's more an, let's call it, algorithm or something, how you calculate it. So you can maybe say, okay, my average tax rate is 30% or 35%, but actually it's calculated by it has to be calculated by a Excel sheet or something, because you cannot just say the rate is such and such. For corporate income tax, it is very different because there we have a flat fee, which is 15%, and it's also based on the annual net profit. In addition to both kind of income taxes, we have a so-called solidarity surcharge, which is 5.5% based on the income tax. So you calculate your individual income tax or your corporate income tax, and then based on this amount, on this tax amount, you pay again or in addition 5.5% solidarity surcharge. So if you are doing business in Germany, also another tax is very relevant for you. It's called trade tax, or in German it's Gewerbesteuer. This is a specific tax which you can actually do not find in other countries, and it's not based on income tax or corporate or individual income tax, but normally if you have a business in Germany, you are also subject to trade tax in any case. So the tax rate, it depends on the seat of the company, but you can say that it's approximately 14%. And normally it's also based on the annual net profit, which you already calculated for the income tax purposes, but there are certain specific amendments with regard to the trade tax. For example, there is a limitation for tax deductibility of certain expenses if they exceed 100,000 euros per year. For example, you cannot limit it 25% of your interest costs. You cannot deduct 12.5% of rental costs of immovable property or 5% of movable property. And you also have a restriction with regard to license payments because you cannot deduct 6.25% of these payments if you calculate your trade tax. Additionally, of course, there are not only restrictions, there are also some benefits. For example, dividends can be exempted under certain conditions, because if a company receives dividends from another company, especially within group structures, then of course these dividends result from profit that has already been taxed on the level of the subsidiary. And therefore, the provision says that if this profit is then distributed to the mother company, you will not pay additional trade tax on these dividends paid. And another very important provision is that also rental income can be exempted in case that you have only performing a pure leasing activity. So if you are only renting houses without offering any additional services, like, I mean, if you are offering, for example, certain facility services, or or if you have a like a hotel where you have a lot of change in the with regard to the persons that are hosted there, then you might have a problem. But if it's what you can think about if it's just a flat rented to a family or something, then this is a pure leasing activity and it's exempted from trade tax. Okay, then of course we also have value-added tax. Value-added tax system in Germany is very similar to the tax system you also know from other EU member states. And the normal tax rate is 19%. There is also a reduced tax rate of 7%, which, for example, is applied for foods or books or some special items. But normally, if you are doing normal business, your value-added tax rate is 19%. Also, a very important tax in Germany is the real estate transfer tax, which is always relevant if you transfer real estate property directly or indirectly, which means that not only the transfer of property, if you transfer it from one person to another directly is subject to this tax, but also, for example, if you have shares in real estate companies and you transfer these shares, then this can also trigger real estate transfer tax. And this is sometimes it's really problematic in practice because sometimes there is a high risk that you might not recognize that if you transfer the shares of this and this entity, this might trigger real estate transfer tax, especially if the whole group structure is very complicated and has a lot of different entities. And because sometimes you have to look through some entities and you have to look to the final and beneficiary shareholder of the whole group to decide if there is a real estate transfer tax issue or not. And the tax rate, it varies from 3.5 to 6.5%, and it depends on the location of the property. And it's calculated on the purchase price or the fair market value of the property. So, of course, if you have a normal purchase, then you take the purchase price, as long as it's quite similar to arm's length principles. For example, if you transfer shares in companies, then of course you have to find another way to calculate the tax base for the real estate transfer tax, because of course then you pay actually the price for the whole shares and not only for the property. And in this case you have to sometimes get a documentation from a qualified auditor or something about the fair market value of this property, and then you calculate your tax based on this value. The last tax I would like to focus on is inheritance or gift tax. So actually each inheritance or gift between individuals, regardless of it is within a family or if it is between unrelated parties, is subject to such tax. And but the tax rate is depending on the family relationship between the heir and the descendant, or the donor and the donee, and it varies from 7 to 50%. I will show you later a more detailed list how the tax rate varies based on the different situations. The tax base is depending which asset you gift or inherit. So, of course, if you only gift cash, then it's the nominal value of the cash. For example, if you transfer real estate property or also business assets, there are very detailed rules how you calculate then the value for the inheritance or gift tax purposes. And normally you can say that if you calculate the value for the real estate property, you will normally reach a value which is lower than the fair market value of the property. So actually the tax value in this case is it's an advantage for the taxpayer that the value is a little bit lower. If you calculate the value for a company, if you gift or inherit shares, for example, in this company or certain assets, then you can say the method how this is calculated is a little bit comparable to let's call it cash flow base calculation, like you would do if you calculate a purchase price, if a purchaser and a seller should agree on a purchase price for the company. But nevertheless, the difference is that you do not take a future approach of the future assets of this company in order to calculate such a cash flow based discounted cash flow method. It's more you take the last 3 years before you inherit or gifted the shares, and you calculate the value of the company based on these annual profits you received in the last 3 years. And then you use a multiple, which is fixed in the law. And based on this calculation, then you receive a value that is that is the basis for calculate the inheritance and gift tax. Nevertheless, if the value you calculated based on the regulations for inheritance and gift tax is much higher than the fair market value of the company, you can ask an auditor to prepare, let's say, another valuation based on general accounting principles, and then also this valuation, if this is below the tax value, you can use this valuation, and so your inheritance or gift tax will be reduced. Okay, any questions so far? Okay. Then I would like to start to give you some indications of the different possibilities to invest in Germany. As already mentioned from my colleagues in the morning, of course you have also 3, let's say, main options to how to invest in Germany. You can have a permanent establishment in Germany, you can have a cooperation or a partnership. And the most common forms of a cooperation is a GmbH, and of a partnership it's a GmbH and Co. KG. It has to be mentioned that in Germany, partnerships are very common legal forms. It's not like in other countries where you just maybe have partnerships but no one uses it. It's different in Germany, especially German clients. Our German clients very often use partnerships. So both options can really be interesting, and of course it's not only tax aspects that should be considered, it's also like the flexibility, how you can transfer shares, how you can make decisions in the company, registrations, obligations, and so on. And it can be said that in general, apart from tax aspects, a partnership in Germany is more flexible, and there are not so many regulations with regard to partnerships. For example, also according to commercial law or something like this, compared to corporations. And therefore, quite a lot of people also choose partnerships in Germany to invest. What I also would like to mention here is that a GmbH needs only one shareholder, whereas a partnership in Germany always needs 2 shareholders at least. And that is why the legal form of a GmbH and Co. KG is quite often used. You can also establish a partnership in Germany if you are only one, because you will establish in addition a GmbH, and this GmbH will be the second shareholder of the KG, and the GmbH will have no participation on the assets of this company. There will be a 0% participation in the partnership, and so actually the only real investor has actually 100% in the partnership. So maybe if I, so you have this structure then in general. You have the German KG or Kommanditgesellschaft, and then you have a GmbH that has 0% in the KG, and then you have your investor, for example, a Latvian individual who has 100%. And this investor also holds all shares in this German GmbH. This is a structure that is very often used, and this enables you to have a partnership, although actually you are only one investor, but you need two shareholders of a partnership. Okay, let's start with the permanent establishment and have a closer look to it. The general criteria for a permanent establishment is that you have, of course, a business activity in Germany, and you have a fixed place of business, and the business is carried out through this fixed place of business, and most often the permanent establishment is established because of a location of management. You have an office, a factory, or a branch in Germany. So this is just the common cases as you also have in Latvia, in Estonia, or wherever. Then, of course, we have also specific permanent establishment scenarios that could trigger taxes in Germany. That's especially the construction PE or the agency PE. With regard to Latvia, the construction activity that exceeds a period of 9 months might create such a construction PE. And in this context it had to be mentioned that Germany normally calculates the time period, the 9 months period, quite strictly. So actually we count on a day-per-day basis. We do not say, okay, now you are 5 days in August here in Germany, and so we count the whole August. This is not how we do it, but we only count the 5 days in August then. And also interruptions of construction work, for example, can lead to the situation that you stop counting and you do not include an interruption period in calculating these 9 months. But nevertheless, okay, this is always something that has to be checked for each individual case, because the reason why you have such an interruption, for example, is also relevant if this stops the counting or of the days or not. And what's also important to understand is that normally a construction P in Germany is only or can only be related to the, let's call it, core activity. So it's the real construction and assembly work. For example, if employees already come to Germany to make some preparation work or just auxiliary activity, normally these activities are not included when counting the 9 months period for a construction PE. The second specific scenario where you normally can create a PE quite often is if you have a dependent agent acting in Germany for a foreign corporation. So for example, if you send someone, or not someone, but an employee to Germany to do some distribution activities, yeah, to meet the clients, to do some marketing activities, and maybe also to conclude contract with clients, then you might have an issue that you create an agency PE in Germany, and therefore the distribution activity or the benefit the profit resulting from this distribution activity might be, or is very likely, subject to tax in Germany. So when you send someone to Germany to do your distribution activities or something, you have to be very careful, because in the last 1-2 years there has also been some discussions on the OECD level on how to treat such agency PEs. And in the past it was more the case than, for example, if the employee did not have the final power of attorney to sign the contracts, then normally you did not create an agency PE. But this has changed. So for example, if you send someone to Germany only to agree on specific regulations for the agreement, and you actually, the employee discusses with the customer every single aspect of the agreement, and then the agreement is only sent back home to Latvia to sign it, then this will not avoid creating an agency PE in Germany anymore. Because now you use more economic perspective than a legal perspective to decide if there is an agency PE or not. Yeah. Elena? Or I can.
Maybe I can speak loud enough. Yeah. But if we hire an independent company agent in Germany, it's not the case.
No, normally if you hire an independent agent, which is really independent, then you don't have a PE issue. But the problem is, for example, the definition, what is independent, is also important. So it's not only that employees are not independent. So for example, if you actually hire a person that is not an employee of your company, but for example, your company is the only customer for such a person, so actually he's only acting exclusively for you and doing distributions activity for you. Although it's not an employee, then you might nevertheless have an issue that for tax purposes it's not independent. That's the case. Any other questions? Okay, so what are the tax consequences if you have a permanent establishment in Germany? The foreign company is subject to limited tax liability in Germany. So the income generated by this permanent establishment will trigger German income tax. And is it also there? No, and actually also trade tax. And it is important to understand that when you're calculating your profit attributable to such a PE, you have to treat this PE actually as like an independent legal entity, but only for tax purposes. Of course, the PE itself is not an entity. It's not independent. It's linked to the foreign company, but for tax purposes, in order to attribute the profits that are generated out of the activities in Germany, have to be calculated based on an approach as if the permanent establishment would be independent. So that's why the permanent establishment has own accounting obligations for tax purposes. And also if you, for example, have activities between the permanent establishment and the foreign mother company, you have to agree on conditions in advance, and you have to fulfill these conditions, and you actually, for example, delivery between the mother company and the permanent establishment has been done based on the price like you would do between third parties. In order, just when you calculate the profit of the PE. Okay, so then let's go on and talk about corporations in Germany. Corporations in Germany, as I mentioned, could be GmbH or also an AG, which is a stock-listed company. And they are subject to corporate income tax in Germany. And it is important to understand that if you have an investment in a German corporation, then you have to distinguish between the level of the corporation and the level of the shareholder. Because normally when the GmbH is doing, because I'm only, actually this is also relevant for the AG, but normally if you have an investment in Germany, you normally use a GmbH. That's why I will actually talk about GmbH. So if the GmbH is doing business in Germany, then the GmbH itself, because it's a German entity, is subject to unlimited tax liability, which means that all the profits generated by the GmbH are taxed at their level, and they are subject to corporate income tax plus solidarity surcharge, which leads almost to an, is there also a pointer? No. To a tax burden of around 16%. Then you have a trade tax of 14%. So you can say that the overall tax burden at the level of the company is approximately 30% if you invest in a GmbH. And this is the final tax burden as long as you do not distribute any profits to the shareholder. So if you retain all earnings in the GmbH and maybe reinvest at the level of the corporation, then you pay 30% and that's it. If you then distribute your earnings, then you pay again tax at the level of the company. And according to our national German tax law, you pay 25% flat rate on dividends. But nevertheless, if you have, here in this situation, you have a border in between. So if you have a foreign investor, then this rate for dividend distributions is reduced based on the double tax treaty that you have with the other country, or also based on the parent subsidiary directive. I will explain this later on in a little bit more detail. But at this time you can say that the tax for dividend distribution normally is only 15% or maybe even lower. And it is also very important to understand that if you have any transaction, any agreements, anything between the entity, the GmbH, and its foreign shareholder, then all of these agreements, calculations of payments, and etc. has to be made as you would calculate it between independent parties. Because, for example, if the GmbH is giving a benefit to the shareholder, because, for example, the shareholder pays from the GmbH or acquires from the GmbH certain products, and the price the shareholder pays for these products is not in line with the market price of such products, then you would generate a deemed dividend from the GmbH to the foreign shareholder. And this means that you would also have to tax a dividend distribution in Germany for this, for this amount. Okay. Okay, so any questions with regard to corporations?
Excuse me.
Yes.
It's small. It is here is dividends Vācijā man ir filiāle, ja? Man ir divas filiāles, divi uzņēmumi.
In Germany there is two entities. One has a profit 90,000 euros. Another branch office has a profit of 200,000.
Это означает, что здесь у меня 48% в налоги и здесь 48% в налоги.
Does it mean that both entities are obliged to pay 48% at the end of the day? Always a shareholder is Latvian company.
So, so we have a Latvian company, and
Into
on the
the
one hand
branch?
it has a branch in Germany, and on the other hand it has
Another branch.
Another branch.
Yes, branch.
Okay.
Все они филиалы.
Okay, yeah.
Вот
Then you
90 тысяч, будет 200.
no. Then you calculate. Maybe. Then you calculate your profit for each permanent or for each branch individually. Yeah, and since the shareholder of the branch is a Latvian company, if it's comparable to a corporation for German tax purposes, then you pay around 30% of the profit of this branch in Germany.
If I may just...
70 чисто ко мне идет в Латвию, на латвийской сети.
Да.
30% там.
30%.
Yeah. Yep.
Я думал, половину, жалко.
Okay, so now we come to the tax system with regard to partnerships, and the tax system that we have in Germany for partnerships is a very, let's say, unique thing, because you will normally not find it in other countries in such a way. Because partnerships are transparent entities for tax purposes. So what does this mean? Also, if you invest in a partnership for tax purposes, you have to distinguish between the level of the partnership itself and its shareholders. And then you have also distinguished between the different types of taxes. So if you are talking about trade tax, then the partnership itself is subject to trade tax. So 14% of the profit generated by the partnership are subject to trade tax, and the taxpayer here is the partnership itself. And then in addition to this, the shareholders of the partnership are subject to income tax in Germany. So the income generated by the partnership is attributed to the shareholders by considering, of course, their shares, their investment in the company, their participation, and then they are personally subject to income tax in Germany, which means if you have an individual as a partner of a partnership, then you pay individual income tax in Germany. If you have a corporation as a partner, then you pay corporate income tax. And you might remember from the beginning, so this means that the profit attributed to a corporation as partner of a partnership can be taxed up to 30%, whereas if you invest as an individual, then you can be taxed up to 45%. So maybe I draw another example. So again, we have the KG as a partnership. And then, for example, let's assume that we have 3 partners. We have one Latvian company, and you have 2 Latvian individuals. Then the situation is as follows. If the KG is generating profit, then you will have 14% trade tax on the level of the partnership, and then you will attribute the profit, let's say it's 100, and for example the company has a share of 50%, and the other 2 individuals have 25%, sorry. Then you would attribute 100 multiplied with 50%, which is 50, to the Latvian company, and 25 to each individual for income tax purposes in Germany. So this means that finally all these three investors have to file an income tax in Germany due to limited tax liability. And so this 50 here are taxed with 30%, and the 25, yeah, it depends what we are finally talking about, but can be up to 45% tax rate. Yeah. And there was some question behind it. Yeah.
Hello. Two questions. This
Yeah.
is first 14%
Yeah.
is deductible from profit because you distributed
No,
100.
it's not. It's not. No.
You
no,
paid
no.
on top?
The issue is that you do not distribute profits in this scenario here. This is just that the KG generates the profit, and regardless if you distribute it
It's
or
not yet distributed.
No,
at
even
all.
if you do not distribute it, you have this tax situation. Because the clue is that if you distribute it afterwards, then you do not pay any more tax in Germany.
Okay.
Because then the distribution, or actually we call it a withdrawal in this case, is not a taxable event anymore.
Okay, I see. And another question. It's mean what trade tax you pay double on level of KG on level of GmbH, no?
Yeah, that's yeah, thank you for this remark. No, finally not, because that it is right that the Latvian company itself, it's also subject to trade tax, that's right, but you would, the 50 here would only be subject to corporate income tax on the level of the Latvian company, but they are reduced from the trade tax base. So you do not pay trade tax twice on the profit of the KG because it is exempt for trade tax on the level of the Latvian company, but only for trade tax, not for income tax. I think there was another question.
Actually, it's the same about this double taxation. So, but
Okay.
anyway, but where is the difference and where is the benefit to make this Kommanditgesellschaft not
Yeah.
einfach Gesellschaft?
I mean, actually, from a tax perspective, it really depends, for example, how much you would like to distribute or withdraw. Because if you would like to withdraw most of the profits, then it can be good to have a partnership because you do not pay extra tax on distributions. Yeah, and it can also be helpful, for example, if you use, but this makes it very complex. If you use the KG, for example, to invest in other countries, then you have the opportunity that you are taxed only with a, let's say, low tax burden in the foreign country, and then you can distribute all the money through the borders up to the final shareholder without paying any more tax. And this is only possible with a partnership in Germany, because if you have a GmbH, then you will be taxed on the distributions again.
Sorry, but if the Latvian company just established not this Kommanditgesellschaft, but SIA, Gesellschaft mit beschränkter Haftung,
Yeah.
profit, tax on profit, it will be the same then. Even higher, 30 and 30. But for Latvian company, also this reduction for this trade tax will be the same.
Here?
Yes, when
No.
Latvian company established not this Kommanditgesellschaft, but Gesellschaft mit beschränkter Haftung.
Yeah.
There is direct structure.
Yeah.
Latvian SIA and GmbH.
Yeah.
Taxes on profit
Yeah,
will be the same.
Then you pay
30 and 30.
30%, and no, then I don't know how it is then taxed in Latvia, because from a German perspective, you would then pay here 30%, and the distribution to the Latvian company between a Latvian SIA and a GmbH is exempt from withholding tax in Germany on dividends due to the parent subsidiary directive. But then it's maybe a tax issue in Latvia. I don't
On
know.
received dividends, we will not pay tax.
Okay, okay. Then it could really be, especially in the specific situation of Latvia, then it might be a higher tax benefit if you invest in a German GmbH. Yeah, yeah. Okay, so here, yeah, this is also what I included in the papers, but this is only the tax burden in Germany, and you can see here you have in the first two situations you have a PE, then you have a corporation, and then you have a partnership, and you see that from a German perspective, if you have a Latvian corporation as a shareholder, then you actually pay the final tax burden regardless if you are investing in a corporation or in a partnership in Germany.
But this is only when the shareholder is corporation.
Yeah. Okay, any more questions about the general tax aspects? Okay, then I would like to point out some special limited deductibility of expenses. For tax purposes, we have a so-called interest barrier rule, and we have also royalty restriction. Normally, especially, the interest barrier rule is only relevant for quite large companies because if it requires that your net interest cost, which means the interest cost less the interest income on the level of the company, exceeds 3 million euros. And if you have such a situation that your net interest costs are higher than 3 million euros, then you normally can only deduct 30% of the EBIT as interest costs. And also this interest barrier rule actually only applies if you belong to a group of companies. So if you are only have one entity in Germany doing business there without any other group relations, then you are not subject to this interest barrier rule. And I would also like to mention that if you have interest costs that cannot not have been deducted in the past, then you can forward it to future periods. And also if you were not able to fully use your EBIT to calculate your deductible interest costs, then both amounts can be carried forward and used in future periods. And then quite new, it was last year or the year before, we get a new regulation with regard to royalty restrictions. So normally royalty expenses are fully tax deductible. There is only a small restriction for trade tax, but normally they are fully tax deductible. But for example, if you pay royalty fees to an entity in another country, and the entity there is the country there has a favorable tax regime for royalty income, so this is taxed very low in this country, and the entity itself does not have any own, let's say, development activities. So, for example, the entity only has the patents and the rights to make license agreements with other entities about certain trademarks, for example. Then you cannot fully deduct these royalty expenses paid to the entity in another country here in Germany. So you normally can only deduct No, it's a certain proportion that you then have to calculate to see what's the real royalty deductible amount. Okay, then I would like to come back to some international aspects. As I already mentioned with regard to dividends and also interests and royalties, there are specific regulations based on the double tax treaties and also due to European directives. And I already mentioned that from a German perspective, if you distribute dividends to a foreign shareholder, then normally you would have to withhold 25% of the dividend of the gross amount as a withholding tax. But of course, that as we are in the European Union, you can benefit from the European directives there. So if you fulfill the criteria of the parent subsidiary directive, so for example, if a German GmbH distributes profits to a German SIA, and the SIA at least has 10% of the shares in this GmbH for a period of 12 months minimum, then no withholding taxes is finally withheld. However, it has to be mentioned that in order to avoid that the German GmbH withhold any tax, it is required to apply for a tax exemption certificate in advance. So if you can, the Latvian SIA cannot present to the German GmbH such a tax exemption certificate, then nevertheless the German GmbH is obliged to withhold 25% of the dividend in a first step, and then the SIA can apply for a refund with the German tax authorities. And therefore we normally recommend that if you have an investment in a German GmbH and you plan to distribute dividends, then you should start in advance to apply for such a tax exemption certificate, but the process will, it will take between 4 and 6 months to get such a certificate. So it is required to start quite early the process before you're distributing dividends. Oh, sorry. If not a Latvian SIA, but a Latvian individual has shares in a German GmbH, then the withholding tax rate is reduced by the double tax treaty between Germany and Latvia, and so it's only 5 or 15% of the dividend payment, and this cannot be reduced anymore. So this is the last reduction available. If you pay interest or royalty fees out of Germany, then it's almost the same or the same principle as for dividends. So, for example, if you can apply for the interest and royalty directives of the European Union, then there is no withholding tax on interests and royalties. But again, it's the same procedure. So, if you want to avoid it completely, then you have also here to apply for a tax exemption certificate in advance. And otherwise, if you do not fulfill the criteria for the directive, then you have to look in the double tax treaty, and it says that then you have, Germany has the right to hold withholding tax on interests of 10%, and in royalty cases 5 or 10%, depending on which royalty fees you pay or which license you actually agreed on. Okay, though, maybe then one other short aspect. So, for example, if you have started activities in Germany, sometimes you want to quit it later on. So if you determine business activities in Germany, there can be capital gains that result from the liquidation or the sale of the company or the shares in the company. So if you achieve, sorry. So if you achieve capital gains with regard to a permanent establishment or a partnership, these capital gains are always taxable in Germany according to the double tax treaty. However, if you determine or if you sell your shares in a German corporation, normally these capital gains are not taxed in Germany because the right of taxation is in Latvia, except you have real estate companies which have a real estate, have a German real estate. Okay. Any questions to the business investment options?
Everything clear.
Okay. Everything clear. Clear and easy to understand. Good.
Nothing but everything.
Okay, then if you would like to acquire German real estate, of course you have also different options. The most easiest case is that just an individual buys or purchases a house in Germany and has it directly as a private asset. The other situation is that you have a Latvian entity that invests in real estate property in Germany, or you can also have the situation that you can interpose a German GmbH and that this German GmbH is the owner of the house, and this will lead to different tax consequences from some aspects. So if the real estate property is a, let's say, is a private asset and you achieve rental income, that the Latvian individual receives rental income out of this property, then the Latvian individual becomes subject to limited tax liability. So all the rental income is taxed in Germany at the normal individual income tax rate, plus solidarity surcharge. So the advantage, the tax advantage is if you have a property as a private asset, then it's the situation when you would like to sell this property again, because if you hold it at least 10 years, then the sale of this property is fully tax exempt in Germany. And this can be, of course, attractive because, for example, at the moment, the value of a real estate property in Germany has been increased during the last years, and so normally if this would continue and you would now buy a real estate in Germany and have it at least 10 years and then you sell it, then the whole value increasing is tax-free. However, you have to be careful that you do not create a commercial property transaction. This means if you have several real estate properties in Germany and you would sell 3 properties or more within a 5-year period, then you would not be regarded as a private investor anymore, but you would change for tax purposes to a business investor, and this means that you cannot apply anymore for the tax exemption of such sales.
Sorry, Claudia,
Yeah.
there is some technical problems and
Yeah.
we should end up within less than 10 minutes, but
Okay.
then we can move for further discussions.
Okay.
So 10 minutes on the
Okay.
screen and then everything else.
Yeah,
We continue.
But I think, okay,
Thank you.
so then I will only point out the most important aspect. So if a Latvian company invests in German real estate, also the rental income will be subject to normal taxation, just corporate income tax that has to be paid in Germany due to the rental income. And in this case, of course, because you do not have any private assets anymore, also all capital gains resulting from the sale of such a property will be subject to tax in Germany. Also, normal corporate income tax, it means 30%, and solidarity surcharge. Yeah, I think we can just leave it. So, okay, then once again, real estate transfer tax, as I already mentioned, not only the direct transfer of property is subject to the real estate transfer tax, but also the direct or indirect transfer of, I was pressed the wrong button. The direct or indirect transfer of interests in a cooperation or partnership having real estate property can trigger real estate transfer tax. And the provisions are very specific. So for example, if you transfer 95% of the shares in a German partnership within 5 years, and this partnership has real estate property, then with the last transaction you will trigger real estate transfer tax. In addition, if, for example, one person receives at least 95% of the stakes in a real estate company, regardless of if it is a partnership or a corporation, then this will also trigger real estate transfer tax. So for example, you have 2 shareholders of a GmbH, and one shareholder already has 60%, and the other shareholder has 40%, and the one shareholder sells to the other shareholder his 40% in the company. Then, if the company is a real estate company, you will trigger real estate transfer tax due to the situation that one shareholder receives more than 95% of this real estate company, and therefore implicitly also of the real estate property itself. And I also would like to mention that there are current discussions in Germany to amend these regulations. So it is discussed that instead of 95% of all the regulations, it should be sufficient to transfer 90% of the shares, and not only within a 5-year period, but also within a 10-year period. So this regulation will be more stricter in future, very, very likely. Okay, then maybe to come to an end, I just would like to explain some specific about our inheritance and gift tax we have in Germany. And actually, I would like to focus mostly on the situation when inheritance and gift tax in Germany is triggered. Because, of course, you find all the tax rates in your slides, so I think you can also read it afterwards. But what is important to mention is if you have the situation that either the deceased person or the beneficiary has its place of residence in Germany, then you will be taxed. If you inherit or gift assets, you will be taxed on all worldwide assets. Which means, for example, if a Latvian individual has a daughter or a son that lives in Germany for a certain period of time, for example, for study purposes or whatever, and during this time period, there will be an inheritance or a gift. Yeah? Then this means that this transfer will trigger inheritance and gift tax in Germany for the worldwide assets, only because of the fact that the beneficiary has its place of residence in Germany at the time when the gift or inheritance is made. This is important to mention because in a lot of countries it is only relevant where the deceased person has its place of residence, and this is not the case in Germany. So you have either the deceased person or the beneficiary. It's only one of them is sufficient. So if you have the situation that the deceased person and the beneficiary are not resident in Germany, for example, they are both Latvian living in Latvia, then you can only be subject to limited tax liability, and this means that only German domestic assets are subject to tax. So, for example, if you have shares in a German GmbH, if you have German real estate property, if you have a permanent establishment in Germany, this will also trigger inheritance and gift tax in Germany, although there is only a transfer between Latvian individuals. Okay, so as I already mentioned, there are certain exemptions available for business assets, but the regulations are a little bit, let's say, difficult, and it has to be really analyzed in detail which provision is applicable. And of course, we have personal allowances. So between spouses, the tax allowance is 500,000. Between children, parents and children, the tax allowance is 400,000. And then you see, if you, for example, if you gift something to a third person, then you only get a tax allowance of 20,000 euros. Okay, and so finally, I just would like to point out that we have 3 different tax classes, and all gifts or inheritances made between or within a family, they normally are in the tax class 1. So depending on the amount of the inheritance or gift, you can see that the tax rate is between 7 and 30%. But the 30% only apply over 260 million euros value per transfer. And if you, for example, give to a third person, then you can pay up to 50% tax. Okay. So this was just a fast explanation.
Sorry, but we can really continue just on our way. And
Yes, of
many
course.
thanks, Claudia, so far. And definitely, if there is any questions, of course, Claudia is here still and available for you. Thank you. Paldies.